So, the topic of discussion would be India's economic outlook for 2024 to 2025. Specific focus would be slowdown and inflation. India's economic landscape in the fiscal year 2024 to 2025 is characterized by moderate growth projections, persistent inflationary pressures, declining private investment, and weakened consumer demand. So, because of these following reasons, GDP growth projections of several institutions such as Asian Development Bank and Reserve Bank of India have revised their projections. So, we'll see how it has happened. The Ministry of Statistics and Program Implementation (MoSPI) estimated that the India's fiscal GDP will grow by 6.4% in 2024 to 2025, which is significantly uh, lower than 8.2% of the previous fiscal year. Despite being the world's fastest growing major economy, the sub 7% growth rate raises concerns about India's long term goal of becoming a developed nation by 2047. So, institutional growth projections: Asian Development Bank lowered India's growth outlook from 7% to 6.5%, citing weak private investment and housing demand. RBI reduced its projection from 7.2% to 6.6% due to economic slowdown and persistent food inflation. So what we'll now connect both net real growth and the inflation. So how it is related? Net real growth is equal to GDP minus inflation. This remains a significant concern because the consumer price index CPI stood at 5.53% in January 2025, and the inflation at rural areas was 6.31%, so which induces price pressures in the rural areas. Food inflation is often close to double digits, significantly reducing the purchasing power of middle and lower income households. Wage growth versus inflation. Though the nominal wages have increased over the years by 0.8% to 5.4%, real wages have stagnated because of the higher inflation that we are facing. With inflation around 5.5%, India's net economic growth is estimated only to be around 0.9%, signaling a significant slowdown in terms of economy. While this has been a concern, certain sectors have performed well, certain sectors have not performed well. So, experiencing a slowdown are these sectors. First would be manufacturing sector, which is expected to grow at 5.3%, down from 9.9% in the previous year, primarily due to decline in the private investment and rising imports. Mining industry, which is projected to be growing at a rate of 2.9%, down from 7.1% of the previous year, reflecting weak global demand and domestic policy changes. Construction sector witnessing slow growth for the first time in the recent years, despite its critical role in job creation. Next are the sectors that are showing resilience despite this slowdown. First would be agriculture. 3.8% growth has been expected in this year from 1.4% of last year. This is due to good monsoon season and higher food grain production. Next would be services sector. While growth remains moderate, IT services and financial sectors continue to attract investments and maintain stability. Next is the key economic challenges that are impacting growth. First would be, as previously mentioned, declining private consumption and middle class squeeze. Private consumption expenditure, which makes up around 55 to 60% of the total GDP, has declined compared to the years in which we focused on pandemic recovery. High taxation burdens from GST and income tax are impacting households' disposable income, especially the lower and the middle class. Next would be rising healthcare cost and stagnant job growth are worsening economic conditions for middle income groups. Next would be the second point would be weak private investment and trade imbalance. Private investment, which is a key driver for any economy to expand, remains sluggish due to high interest rates and global economic uncertainty. Goods exports stagnated at just 2% of the total global world share in 2023. Imports are rising, increasing the trade deficit and not attracting, affecting domestic job creation. Next would be capital outflows and currency depreciation. Foreign direct investment: India received about $49 billion in FDI inflows between the April and October 2024, but the divestments reached $34 billion in the same period. Next would be foreign portfolio investment (FPI) recorded net outflows, adding pressure on the Indian rupee. Therefore, Indian rupee was leading to a depreciation in its value towards the end of 2024. So, the conclusion navigating the economic slowdown would be through revising the policy and the economic reforms in the 2025 to 2026 budget, which has already been put forward now. This has to be properly implemented in order to not let the economy slow down furthermore. So, while India remains the fastest growing major economy, the 2025-2026 budget should increase public private investment, enhance tax reforms, supporting domestic and manufacturing. So, domestic manufacturing and exports, stabilizing the currency are some of the measures that uh, India should look upon. Thank you.